When it comes to investments, have you ever found yourself caught between choosing a lump sum or a systematic investment plan, also known as SIP? This question plagues many investors, from the fresh-faced novices to the seasoned pros. Before we dive into the deep end, let's take a moment to understand these two investment methods. A lump sum investment, as the name suggests, involves investing a large sum of money all at once. Imagine you've just received a windfall, say an inheritance or a bonus, and you decide to invest it all in one go. That's lump sum investing. On the other hand, a systematic investment plan, or SIP, is like a disciplined savings plan. You commit to investing a fixed amount regularly, say monthly or quarterly, over a long period. Both methods have their pros and cons, and the choice depends largely on your financial goals, risk appetite, and investment horizon. To help you make an informed decision, let's delve deeper into these two investment methods and compare them. First, let's take a closer look at lump sum investments. Lump sum investments are a straightforward concept. Imagine having a sizable amount of money that you're willing to invest all at once. That, in essence, is a lump sum investment. You're putting a large chunk of your money into an investment vehicle, such as a mutual fund or a stock, all in one go. Now, why would you want to do that? Well, the most significant advantage is the potential for high returns. If the market is on an upward trend, your lump sum investment could grow exponentially. Let's consider a simple example. Say you invest a lump sum of $10,000 in a mutual fund that yields an average annual return of 10%. In 10 years, without adding anything more, your investment could grow to nearly $26,000. That's the power of compounding, working to multiply your money. However, lump sum investments are not without their risks. The market, as we know, is unpredictable. If it takes a downturn shortly after you've made your lump sum investment, you could see a significant reduction in your investment's value. This risk is particularly high for those who are new to investing or those who cannot afford to lose a large portion of their capital. It's also worth noting that lump sum investments require significant upfront capital, which may not be feasible for everyone. You need to have a large amount of money on hand to invest, which can be a barrier for many potential investors. So, while lump sum investments can offer high returns, they also come with a higher risk and a higher barrier to entry. It's an investment strategy that requires careful consideration and a thorough understanding of the market. So that's how lump sum investments work. But what about SIPs? Let's explore. Now, onto systematic investment plans, or SIPs. Systematic investment plans, commonly known as SIPs, are a disciplined approach to investing, where you commit to investing a fixed amount regularly, regardless of market conditions. This method of investment is akin to the age-old practice of saving a little from your earnings, but with a twist. Your savings are put to work in the investment market. Imagine it as a piggy bank, but instead of just collecting coins, this piggy bank has the ability to grow your money over time. And unlike a traditional piggy bank, you're not putting in a lump sum of money all at once. Instead, you're regularly feeding it smaller amounts. Let's delve into the benefits of SIPs. First is the power of compounding. When you invest regularly over a long period, your money generates earnings, which are then reinvested to generate their own earnings. This cycle leads to exponential growth of your investment over time. Second, SIPs allow you to take advantage of market fluctuations through a concept known as rupee cost averaging. In simple terms, when the market is down, your fixed SIP will fetch you more units of an investment and fewer when the market is up. Over time, this averages out the cost of your investment, potentially reducing the risk and enhancing returns. However, just like any investment avenue, SIPs come with their own set of risks. Investment markets can be volatile, and there are no guaranteed returns. Your investment might not grow as expected. So it's always wise to make informed decisions and perhaps seek advice from financial experts. Now let's do a simple calculation. Suppose you decide to invest 1,000 rupees per month for 20 years. Assuming an average annual return of 12% at the end of 20 years, your investment would have grown to approximately 48 lakh rupees. With an understanding of both lump sum and SIP investments, we can now compare them head to head. It's time to put lump sum and SIP investments side by side. Let's begin by imagining you have a sum of $100,000 ready to invest. If you choose the lump sum route, this entire amount is invested at once. Let's say you've invested in a mutual fund that promises an average annual return of 10%. After 20 years, thanks to the magic of compounding, your $100,000 has grown to a whopping $674,000. Quite the nest egg, isn't it? Now let's consider the SIP route. Instead of investing the entire amount at once, you decide to invest a fixed sum each month. Let's assume you invest $833 monthly, which adds up to the same $100,000 over the course of 10 years. Since you're investing gradually, you're also taking advantage of market fluctuations. When the market is low, you buy more units of your chosen investment, and when it's high, you buy fewer. This is known as dollar cost averaging. Assuming the same 10% average annual return, at the end of 20 years, your SIP investment would amount to approximately $740,000. That's a significant increase compared to the lump sum investment. So is SIP the clear winner? Not so fast. The SIP strategy works best when the market is volatile, allowing you to buy more when prices are low. However, if the market is steadily rising, a lump sum investment could potentially yield higher returns, as the entire sum is exposed to the growth from day one. Additionally, the choice between lump sum and SIP can also depend on your financial situation. If you have a large sum ready to invest and are confident about the market's growth, lump sum could be the way to go. On the other hand, if you prefer to invest gradually and mitigate risks associated with market volatility, SIP could be a more suitable option. Crucially, both lump sum and SIP investments carry their own risks and rewards. Lump sum investments carry the risk of timing the market incorrectly, potentially leading to lower returns if the market falls after your investment. On the other hand, SIP investments spread this risk over a longer period, but also potentially dilute the returns in a consistently rising market. In essence, the choice between lump sum and SIP is not a one-size-fits-all decision. It depends on one's financial goals, risk appetite, and market outlook. It's about understanding your own needs and making an informed choice. As we can see, the choice between lump sum and SIP can depend on various factors. So, what can we take away from our exploration of lump sum and SIP investments? Let's summarize. We've seen that both lump sum and systematic investment plans, or SIPs, have their unique strengths and challenges. Lump sum investments are a one-time investment strategy where you put a large amount of money into a specific investment at once. The advantage here is the potential for significant returns if the market performs well. However, this approach also comes with the risk of market volatility and requires a substantial initial capital. On the other hand, SIPs involve investing a fixed amount regularly over a period of time. This approach is especially beneficial for those who prefer a disciplined and systematic investment strategy. It provides the advantage of rupee cost averaging, which can help mitigate the impact of market volatility. But the returns may be lower compared to a well-timed lump sum investment. The choice between lump sum and SIP investments is not a one-size-fits-all decision. It depends on various factors, such as your financial goals, risk tolerance, investment horizon, and market conditions. If you're someone with high risk tolerance and have a substantial amount of money to invest, a lump sum investment could be a good option. But if you prefer a more disciplined approach and wish to mitigate the risk of timing the market, then SIPs could be your go-to strategy. Remember, investing is not just about choosing the right investment strategy. It's also about staying committed to your financial goals and adapting as necessary. Whether you choose lump sum or SIP, it's crucial to regularly review your investments and make adjustments based on your evolving financial goals and market conditions. Remember, the decision between lump sum and SIP should align with your financial goals and risk tolerance. Thank you for watching. If you found this video helpful, please like, share, and subscribe to our channel for more insightful content on investing.